numbers, Kavita, these are daily average volumes for the last 1 year, 3 years, etc. So we're not talking about a very short period of time. These are average volumes over a period of time. And these data are available in public domain. In fact, in the stock exchanges, NSE or BSE, all investors have to do is type the ETF, just like how you search for a particular stock, you type out the ETF and then select a period, you will get to know what are the kind of volumes that are happening in that particular ETF. Then as investors, if you're comparing and if you're considering investing in a particular category of ETF and you're comparing, let's say, 2 or 3 different ETFs, you can just check what has been the volume. That's number one. Second, there is also this figure which is published called impact cost. IC impact cost. That number also is a very critical number. In fact, for our Nifty ETF today, if you go and type and search in the exchanges, you will find a number of 0.02. So what it means is that suppose 100 rupees is the NAV, and if you are buying or selling with 0.02% difference, you will actually be able to buy or sell. On the other hand, some other ETF where the volume is less and therefore the impact cost is high, and we have noticed that in some ETFs, even in large categories, that number is as high as 1% and sometimes even 2%. Now, what that means is we just talked about Nifty hitting a lifetime high of 22,000. Suppose you are selling Nifty, if the impact cost is 1%, you will be selling it at 200 points lower, not at 22,000. That's the kind of impact it will have on your return. So expenses, there are other aspects, but this impact cost because of liquidity or the lack of it, if it is very high, that directly affects your investment. Therefore, investors will have to pay attention to this.
Exactly. So you think that liquidity has to be one of the main factors, impact cost has to be one of the main factors when one is investing in an ETF?
Absolutely, absolutely. In fact, all these concepts are related. Higher volumes lead to higher liquidity, obviously, and that results in lower impact cost, and that has a direct bearing on returns. The other aspect to keep in mind is the expense ratio. But generally, most of these ETFs anyway tend to be low on expense, and they may be comparable. But the moot point here is that you should not be guided only by the expense ratio. A fund having a lower expense ratio, if on the other hand the liquidity is poor and if the impact cost is very high, that may defeat the entire purpose of low cost investing through ETFs.
So, Arun, how can you exactly place an ETF in your portfolio? If I have to discuss the portfolio placement of having ETFs in their portfolio, what should be the kind of ETF that one should be opting for if one is wanting to have a passive exposure in their portfolio? How should be the strategy looking at the current market situation?
Sure. So ETF or any passive investing is just one way of investing, right? There are various types of investing. There's just one type where you do not take an active call on which stock to buy, how much to buy, sell, etc. You simply buy the index and you just replicate a particular index in the case of ETF. Again, within that, there are a lot of different types of funds or different categories. So there are market cap based ETFs or index funds. For example, Nifty, which is again the top 50 stocks, which is large cap stocks. You have that. If you want to play the broader market, there are mid cap and small cap strategies as well. So all these strategies can be considered as diversified categories where you're playing a particular part of the market. So if as an investor, if you prefer to play small cap, you can do that through passives, through index and ETFs as well. Likewise, there are other strategies as well. There are sectoral or thematic offerings as well. For example, as an investor, if you like banking, off late, for example, IT has been buzzing. So you're confused as to which stock to buy, how much, when, etc. Each of the company results are very, very different. Their movement could be different. But you like IT as a story, you simply go and buy a IT ETF or a IT index fund. That's another way to play these passives. Then there are also interesting strategies, what we call as smart beta or a very nuanced niche strategies. For example, low volatility, combine alpha with low volatility, momentum. There are various strategies that you can do. Dividend yield. If you want to play public sector banks, PSU banks, you have options there. If you want to play the public sector basket, we have a ETF called the CPSE ETF, that is a Central Public Sector Enterprises ETF. So there are a whole lot of options available within the passives. But the key difference here is that there is no active fund manager involved in terms of selecting within IT, let me buy this more, that stock less. That decision is not there. Otherwise, even in passives, you have a whole lot of very, very interesting options.
Sure. Just going back, I want to understand how has the ETF as a space performed since its inception, or how has the evolution been?
So they've been growing quite substantially over a period of time. As I said, already they are reaching close to about 8 lakh crores. A combination of institutional investors, individuals, high net worth individuals, and gradually even retail investors are getting into this space. But we still have a long way to go. In the developed markets, obviously, passives account for a significantly larger portion of the overall AUM. In fact, in many markets, the passives are larger than the active funds. In India, the concept is just picking up, but it's rapidly growing. The pace at which it's growing, one can expect that the overall size of this space, particularly, is likely to be significantly higher as we go along.